You cannot time the market. Nobody can. Not Warren Buffett, not the best hedge fund manager on Wall Street, not you. If you could, you'd be on a beach somewhere with your favorite drink in your hand and not listening to me on YouTube. But if you have $2 to $5 million saved and every market drop makes you check your account balance, you're trying to time the market. And it's one of the most expensive habits in retirement. And psychologically, it's debilitating. Think back to 2022. It was the worst market year since the Great Recession. If you felt like checking your balance every day or calling your advisor 9 times in 6 days, you might be falling into that trap. I met a prospect around that time, and he was similar to that. 67 years old, 14 months earlier, he'd retired with about $2.9 million saved. The number he'd spent 40 years working towards. And in the previous 9 months, he'd watched his portfolio drop by $478,000, nearly $500,000. Bonds were down, stocks were down. The one thing every advisor had told him for 30 years was just to diversify and you'll be fine, but that stopped working in 2022. Stocks and bonds both fell in tandem. When we met, he was days away from moving everything to cash. Luckily, he didn't, and by the end of 2023, his portfolio was back above his high water mark. It was about $2.9 million, and he was still getting about $100,000 a year in retirement income without him ever selling a share. That conversation didn't happen because there is some crystal ball that advisors have that you don't. Frankly, nobody has that crystal ball, but there are set principles you can follow to help with the psychological aspect of market drops. This all happened because we helped him rethink his cash flow structure after we met. So even though the stocks were down about 22% that year and bonds were down about 13%, he didn't have to sell anything. Well, he did sell a little bit, and we'll explain why here in a few minutes. His life was already funded, though. The market was doing what markets do, and it didn't matter because none of the money he needed for the next 4 years was invested in it. So here's what I'm going to show you, the game you should be thinking about playing instead of market timing, the 3-bucket structure that makes market volatility irrelevant to your income, the specific rules for when to refill each bucket, including the one rule most people get wrong that costs them 6 figures, and the 3 situations where this whole strategy doesn't work. So you know what you're getting yourself into. And stay to the end, because the confession section in the middle of the video is where I tell you what buckets are actually doing, and it's not what most advisors actually are telling their clients. I'm Ryan Knoll. I'm the founder of Nav Wealth. We work with families in the $2 to $5 million range, households that have done the hard part. You saved, you built real wealth, and now you just want a plan that'll let it last the rest of your life as tax efficiently as possible. Our job is to help you make sure the money you built survives those next 2 to 3 decades without having to check your portfolio balance every morning because you don't know what's going on. The anxiety I'm about to address is one that quietly costs $2 to $5 million households the most money in retirement. Not the tax bill, not the fees, it's the panic selling that happens when markets pull back. So let's jump into the video. The first thing we're going to talk about is the 2 games, and here's the frame that people don't necessarily look at when they retire. You spent 40 years playing one game. You call it the accumulation game. That's what we call it here at Nav Wealth. The rules were simple. You had a paycheck coming in every 2 weeks or every 1st and 15th of the month, whatever your pay schedule was, it came in automatically on time, and you saved a percentage of that. You put that saved money into the market. So it went into your 401k or your IRA, whether it's Roth or traditional, you invested it and that money grew. When the market went down, you were kind of happy though, because that means your next paycheck bought more shares at lower prices. Time was on your side and volatility was actually your friend in this instance. The game was to buy consistently, hold long term, don't panic, and let the compounding do the work. And you won that game. Your balance is the proof of that. And the fact that you're watching this with $2 to $5 million in your accounts or more is further proof that you're still doing things okay. The day you retired, though, is the day that game changed. Nobody handed you the new rulebook, and most advisors don't mention it within their transition of working to retirement. But the rules are completely different. And in the new game, there's no paycheck coming in every 2 weeks. Maybe once a month if you have a pension and Social Security, and maybe you do segment those so the pension comes in the middle of the month and the Social Security comes at the beginning. But it's not nearly to the same extent it was while you're working. It's typically 60 to 70% of what you made your last year. And that's at the high end. The money you need to live on has to come from somewhere. And if it comes from selling shares in a downturn, you've done something the old game never made you do. You've locked in a loss, or you've locked in severely depreciated prices from where they were at their relative high. You've sold at the wrong price, and every dollar you sell in a bear market is a dollar that isn't there to recover when the market comes back. And this is what we call here at NavWealth the distribution game. And here's what makes it feel so brutal. The exact same behavior that made you rich in the accumulation game, staying invested, riding out volatility, not touching the account, will destroy you in the distribution game if you don't structure the account differently. Because in the distribution game, you have to touch the account. You need it to sustain your lifestyle, so you have to withdraw. The question is, from where do you withdraw though? The two games have different rules, but almost nobody redesigns their portfolio when they cross the line from one to the other. They just keep playing the old game of the portfolio that was built for it. And then they wonder why every market drop feels like a threat instead of an opportunity. It's because in the new game, it is a threat, unless you've built the structure that makes it not one. That's what buckets are. They're not a mechanism for beating the market. They're a mechanism for making the market irrelevant to your monthly income. And that changes everything about how you experience retirement. So let's talk about the three buckets, specifically the structure and the different jobs of each. So the structure within the three buckets, all of them have different jobs, different vehicles, and different rules. Bucket one is your income bucket. We typically like to target here at NavWealth 12 to 24 months of expenses for our clients, depending on how aggressive they are. You hold these in cash and short-term treasuries, not 1 month, not 6 months, 1 to 2 years full of what you actually spend. So somebody who spends $100,000 would have $100,000 to $200,000 in this bucket of their accounts. And that sits in high yield savings, CDs, and treasury bills, earning something like 3 to 5% range in today's current rate environment. And it's completely disconnected from stock market volatility. This is the money you actually pay bills with: your property taxes, your groceries, the mortgage if you still have one, healthcare premiums, everything. Every dollar that leaves your account to fund your life comes from bucket one. The reason it's at least a year or two and not less is historically the average bear market is 12 to 14 months long, and the average recovery, meaning going from that high point to the low point and then back up to the high point, is another year to 18 months. So 12 months ensures that you're insulated during the pullback for the most part. 24 months means you can ride through a full bear market and recovery cycle without ever having to sell an equity share to pay for your life. Now, that's not a hedge, that's a guarantee. It's also psychologically empowering. Within those 24 months, the market behavior is completely irrelevant to your income. So you know your bills are paid and you have time to wait out this market downturn. And I want to be clear that this is the average case. There are outliers, such as the last decade, where it took longer to bounce back, or COVID, where it all happened within a 9-month period. I think we were from the previous high to the low point was like March of 2020, and then by October, November, we were back at another high. So we build around this average case and the median case because it's more representative. We also do it because of how we position bucket number two. And bucket number two is your buffer bucket. Years 3 through 5 of expenses are held in a treasury ladder, short duration bond funds, longer term CDs, and potentially even multi-year guaranteed annuities, depending on where you get the best after-tax rate. So for a couple who's spending $120,000 a year in retirement, they're looking at another $360,000 to $480,000 on the same $120,000 spending assumption. This bucket doesn't fund your life directly. Its job is to refill bucket one as bucket one drains, but only under specific conditions I'll walk through in a minute. The vehicle matters. It's not intermediate bonds, it's not long duration bonds, and it's not high yield bonds. It's treasuries laddered to mature in 2 to 5 years, plus short duration bond funds with average durations under 3 years. And why is that? Well, it's because bucket two's job is to be there when you need it. Long bonds fell 13% in 2022. We covered this earlier. Short bonds, though, they fell about 3 to 4%. The point of bucket two is stability, not yield. What I like to set up for clients is a cash buffer in bucket one and a short-term lower risk, lower duration fixed income sleeve. Because this buys you enough time to wait out down markets in most cases. Remember that average case, 12 to 14 months for a pullback, another 12 months to 18 months to get back to the market high on average. So if we have our bucket one, where we have 1 to 2 years of expenses saved up, then we have bucket three, where we have another 3 to 4 years saved up, we are able to outlast most market cycles when the pullback happens. So between buckets 1 and 2, we typically try to achieve at least 3 years of protection for our more aggressive clients and up to 5 years for our more conservative. So someone with $3 million who spends $120,000 annually and tends to be more conservative would have roughly $600,000 in buckets 1 or 2. That's 20% of their portfolio, which leaves them with the remainder going into bucket 3. And bucket 3 is your growth bucket. Everything else held in a globally diversified equity portfolio. And before we dive into that, I want to chat about the stock to bond allocation here, because most people follow blind rules like 100 minus your age, which for a investor who's 60 years old and retired, you would say, take the number 100, subtract my age, that's 60. That leaves me with 40. 40% would go into equities and 60% would go into bonds. So a much more conservative portfolio, one that might be too conservative and one that might not keep up with inflation, as well as something that's a bit more in equities. So we follow it based off this cash flow approach, where we're able to look at the market cycles on average and understand that when the market pulls back, if we have a 5-year buffer, even a 4-year buffer, more often than not, we've been able to wait out the bad market cycles, get our client accounts back to even or better, and then continue refilling our buckets. And we'll go over the refill strategy here in a second. So for a $3 million household spending $120,000 a year, bucket 1 and 2 hold roughly $600,000 to $700,000 in that instance. Bucket 3 is going to hold the remaining $2.3 to $2.4 million. This bucket is where the growth happens. It's invested for the long term. It's exposed to volatility, and has to be because inflation over 30-year retirement is the single biggest threat to your money. And only equities have historically outpaced it by a sufficient margin, meaning more than 1 or 2%. And here's the critical rule. Bucket 3 doesn't fund your life, not ever. Not directly anyways. You do not sell shares from bucket 3 to pay for anything. Bucket 3's job is only to feed bucket 2, and bucket 2's job is only to feed bucket 1, and bucket 1's job feeds you. And even that flow doesn't happen every year. It happens under specific conditions, and that's the structure. Now here's the honest part about what it's actually doing. Because if I don't say this, the rest of this video is just another bucket strategy, and there are 100 of those out there. The 3-bucket system isn't primarily about math. If you ran a mathematical optimization on the right way to structure a retirement portfolio, buckets would probably not be the answer. A math optimized portfolio would probably look like a straight 70-30 stock to bond allocation with quarterly rebalancing. And on a spreadsheet, it would perform roughly the same as the bucket strategy over 30 years. The reason I don't recommend the math optimized portfolio to my clients is because it doesn't work in the real world. Not because the math is wrong, it's because the math assumes something about you that isn't true. It assumes you're a rational actor who stays disciplined when your account drops 30%. I've had clients call me at the market bottoms, and I could hear the fear in their voice. Some of them wanted to sell everything, some of them almost did, and these aren't stupid people. These are engineers and physicians and business owners, people who ran their careers with discipline and made hundreds of good decisions to build a $2 to $5 million portfolio. So they've won by any stretch of the imagination there. And when the market dropped 22% in 2022, their nerves took over anyway. Because when you're 67, watching the number that represents your entire life savings drop by $500,000 or more, something in you doesn't care what the math says anymore. Something in you wants to make it stop. I've walked a few dozen clients through this exact scenario in the last 5 years. The market drops, they panic call, the moment they almost sell. Every single one who held on came out ahead. Everyone who sold at the bottom is still trying to recover from it 3 years later. The pattern doesn't change. The structure that lets someone hold on when their nervous system is screaming at them to sell, that's what buckets are actually for. The bucket system is a behavioral firewall. That's what it's actually doing. When that prospect called me in October 2022, the reason he didn't sell everything wasn't because I convinced him the market would recover. It was because after looking at his portfolio, we did have to sell a little bit, but just to make sure he had a sufficient bucket 1 of 24 months. He was trending on like 6 months of expenses saved up. We needed to stretch that out. So when we went over the portfolio to give him some peace of mind, we sold enough to make up another 18 months worth of expenses to completely fill his bucket 1. And then we allowed the rest to recover, and that was a better alternative to selling everything. Yes, he lost some money on those shares that he did sell, but the peace of mind knowing that the majority of his funds were still in the market, he can meet his expenses for the next 2 years and ride out the recovery, allowed him to sleep a little bit better at night. And that's what buckets buy you, not maximum returns, sleep. And in a 30-year retirement, sleep is what lets you stay invested long enough for the math to actually work. If you're building the structure yourself and something in this video isn't landing, that's the review that our team does. Look at your real accounts, your real expenses, your real emotional relationship with market volatility, and build a structure calibrated to you. The booking link is in the description. If that sounds interesting to you, go click it. And I'm not going to pretend like this is hard and frankly is not the sole reason you should even hire an advisor. And I'm okay with giving it away for free on YouTube because I see a tremendous amount of risk in retirement accounts today. That is due to, by and large, the fact that the market has pretty much only gone up since 2009, with the one exception, I should say the one big exception being 2022. We did have a few smaller down years in between there. So people have become more accustomed to being rewarded for their risk. It's not uncommon for someone to call me needing income of $100,000 or more from their portfolio of $2 to $3 million, and 100% of that is in equities. And with low interest rates and government subsidies like we've had for the last 2 decades, it's worked out pretty well. In today's environment, I am less convinced that it will continue to do so. Now let me show you what exactly happened in October 2022. I'm going to share my screen and we're going to go over that case study. All right, so the first thing I want to do is I want to go through the different buckets of where we're placing money bucket by bucket. So that way you have an understanding of how exactly we're driving returns while limiting risk here. So what you see here is just the stats of bucket 1. And remember, bucket 1 is 12 to 24 months of cash. So for this person, we're going to consider them a conservative bucket person, which means 24 months of their cash reserve, or they're going to have cash reserve of 24 months of expenses. So what you'll see here is strictly what the cash account is. So there's nothing fancy, not a ton of growth here. What you see here is over the past, 15, 20 years or so, a 2.95% rate of return. So we're not exactly trying to light the world on fire here with getting a huge rate of return. Again, this is the safe money. If you're like, we'll run this portfolio back over the last 60 years or 20 years or so against a 60-40 portfolio, you see we're greatly trailing the market in this instance with that traditional 60-40 retirement portfolio. But that's kind of by design. We're not trying to do well here. And the reason we're not trying to do well here is because when we actually go to stress test this, we don't want to see any market movement other than a little bit of interest earned. So whether the market's up like it was in 2013 bull market, which you see up the top here, and the S&P 500 is up 32.3%, we were at 0.4. Or the '08 bear market when it was down almost 37%, we're still at 0.4 in our bucket 1. This is our cash strategy. The financial crisis was a horrible time for the S&P 500. We're still going to sit right at that 0.4%. You'll see that regardless of what's happening during the market moves, this portfolio hit 0.4%. So 2022, when inflation crashed both the equities and the fixed income, the S&P 500 is down 18.2% in that instance. We were at 0.4. That Barclays Ag or the iShares Ag was down 13.3%. That's just the fixed income market. We were up 0.4. And this is the cash count again. Not trying to lose money here, not trying to gain money here. This is the money that's going to be spent. Any interest we earn is just gravy. That is what it is. We're not trying to do anything crazy here. So with that said, now we're going to move on to bucket 2. I'll show you bucket 2 is slightly different than bucket 1. And now this is bucket 2. And bucket 2 is a little bit different. So here what we have is we have 50% of the portfolio in short-term bonds and 50% of the portfolio in shorter-term CDs. So again, this is the 3 to 5 year bucket for this client because we know the first 2 years is held as cash. So now we have years 3 through 5 held in this 50-50 short-term bonds and CD allocation. So you'll see here the annual returns slightly higher, 3.18%. There are some down years here, very small down years. Again, we're not taking a huge amount of risk here, but as you'll see here in 2022, this part of the portfolio, I think was down a little bit when we go to look at the stats. But the high level thing here is we're still not trying to perform anywhere near what the 60-40 portfolio is doing. So you'll see here over that same time frame, it's up 450 some odd percent for the 60-40 portfolio. This part of the portfolio is only up about 20. So slightly more than what you would have gotten with the cash. Because it's a little bit longer of a duration. It's not money that we need to be using. But at the same time, this isn't the growth portion. We're not looking to get a growth or equity-like returns because we're trying to avoid these drawdowns like you see here in the graphs. So let's go to the scenarios here, the different stress tests here. So you'll see here, 2013 bull market would happen again. S&P, like we know from a few minutes ago, it's up about 32.3%. Bucket 2 is up 0.4. If '08 were to happen again, when the market was down almost 37, this portfolio would have been up a little bit more than 3. Same thing with the financial crisis. Even though the financial crisis was a bit bigger of a pullback, this portfolio still would have been up. The one thing that I do want to caveat here is even in the 2022 inflation crash, be it equities and fixed income were down, we actually saw this portfolio drop. It didn't drop nearly as much as what the aggregate bond index did, but it was still down. So this part of the portfolio isn't completely insulated from loss. The losses are going to be significantly muted in most cases because we do have a significant portion here held as cash, which would be the CD side of things, or this could also be your multi-year guaranteed annuities if you're using those as a cash buffer or cash replacement here. But this is where we're starting to see slightly more risk, slightly better overall returns, the expectation here, but we do see a little bit of downside, and that's okay. We're willing to take that because we know this is money you're going to spend for at least the next 2 to 3 years, because this is for replacing that bucket 1 money. Now we're going to go on to the growth portion, which is actually what's going to drive this portfolio of moving forward. All right, so what you see here is I layered in bucket 1 is roughly 8% of this client's portfolio, and this is assuming the same $3 million client who's $120,000 to live off of. This is where I'm coming up with the percentages. Has about 8% of the portfolio held as cash. The other 12%. So again, bucket 1 to 2 years. This is 2 years in this instance. Bucket 2 is another 3 years. So this is years 3 through 5. That's the short-term bonds and CDs. Then we have our aggressive with alternatives portfolio that we've been running here at NavWealth for a few years. That's what we're doing with the remaining 79-80% of the portfolio. So I want to do is I actually want to go through and look at the stats of this, because this is where things get really interesting. So you'll see by adding that aggressive sleeve or the stock sleeve, the equity sleeve here, our annual midpoint range, what we're expecting as an annual rate of return, a little less than 9%, is what we've seen historically when we run this all the way back over the last 15, 20 years here. When you compare this to the S&P 500, this is what's really interesting to me. It is slightly outperformed the S&P 500. I think a lot of that is a function of having those built-in buffers and buckets. The S&P's completely exposed to all the drawdowns in the market. So when you have '08 as one of the years in there, '08, '09, we had the great financial crisis as part of the return here. That's obviously going to lend itself better to be a more conservative portfolio because you're not affected by nearly as much of that drawdown. But you'll see, this portfolio, the way it's structured, has actually outperformed the S&P 500. Now, I'm not saying that's going to continue in moving forward, but that's just, what the numbers have dictated over the past 20 some odd years. And I think that's interesting about that is you actually look at the risk score, the conservative bucket, because of the cash and the short-term bonds that we have in that portfolio, is a lot less risky than the S&P 500 on a scoring system. I'm not going to get too deep into that, just pointing that out there. But what you see here, and I didn't show this in the last two because they're just cash accounts, you're seeing a very diversified portfolio. So, dark green is correlated positions. So some correlation here, but these blue bars here, these are very uncorrelated positions or less correlated. And you want to have less correlation within the portfolio because that means you're not all moving in the same direction. From an asset classification, there's the 80% in stocks, so roughly 80% in stocks here, is all in these like green or teal bars. There's the cash allocation, and then the government bonds. Other is some of the we have some hedge strategies in the portfolio right now, so that's what's counting as the other portion here. So what you're seeing here is by layering on some risk, we're getting market-like returns, or we're beating it by a little. But again, this is just, I would consider this market-like returns. It's not substantially beating it. This is net of all fees that we charge. And then if we walk through those same stress tests, what happens? So you'll see here in bull markets, we trail, and I would expect to trail. We're taking less risk. So the S&P 500 is up 32% here. We're only up about 25%. But in bear markets, I don't expect to have the full downside. And that's exactly what we're seeing here. So in the next two bear markets, which are the '08 bear market and then the financial crisis, while the portfolio is still down, it's not down nearly to the magnitude of the S&P 500 here. Again, diversification. This is why we go through this. This is why we walk through it. Interest rate hikes, you see that here. It's not a huge difference, but it's about a 7 percentage point, 8 percentage point difference. And then again, if the inflation crash were to happen,
we're not down as much as the S&P 500, but we are down a little bit more than the Barclays Ag, which again, this was that area or that point in time where both stocks and bonds fell in conjunction with each other because the stock market was selling off and the Fed was raising interest rates, causing the bond market to lose value. The conservative bucket did lose out here, even though we have some of that built-in diversification and everything. So the idea here is as we build out a portfolio, it isn't so much maximizing return. We happen to be beating the S&P 500 here with this portfolio. But the main idea is how do we get your cash to you with as little risk as possible? So when these things happen, like the pandemic or the financial crisis or the '08 bear market happened, we have enough time to allow you to recover like it happened in the 2013 bull market. So the idea here is by segmenting your cash flow, by having a good buffer of 3 to 5 years of cash and short-term bonds on hand, segmented in bucket 1 and bucket 2. We have enough time for bucket 3, that growth bucket, to get you returns like this. And if we add a little bit of protection on the downside, we're also not down nearly as much as these bear markets were in 2008, 2009, and then again in the pandemic and then 2022. That's the whole idea behind how we manage portfolios. It's the whole idea about how you should think about managing your own portfolio in retirement. Try to take the necessary risks where you have to, but limit risk by providing yourself with a cash flow cushion, because the bigger your cash flow cushion, the more you can wait out a bad market.
Now, most people have heard of the bucketing strategy, but not many people have been shown how to refill those buckets over time. And that's where the majority of implementations fail. Buckets don't stay balanced automatically. They drain, they refill, they get rebalanced. And when you refill matters as much as how you structure them. So rule number 1 is to refill bucket 1 from bucket 2 in normal markets. In a normal year, the market's up or maybe the market's flat or even moderately down. Bucket 1 drains as you spend. When bucket 1 drops below a 6-month variance of your expenses, you refill it from bucket 2. So if your target is a year in your bucket 1, when cash reserves go to 6 months or less, that's when it's time to refill. If you're on the 2-year target, it's when you get to 18 months or less. Then you refill bucket 2 from bucket 3 back to its target level. This happens once or twice a year in normal conditions. I'm stressing the word normal conditions. Nothing dramatic here. Let's go over the next rule now. So rule number 2 is refill bucket 2 from bucket 3 by selling equities during rebalancing, but only when bucket 3 is at or above its target allocation. So think back to the couple who needed $120,000 a year to live and ended up having an 80-20 portfolio. The target allocation is that 80-20. So if bucket 3 is now 85% of the portfolio, that's a good time to rebalance. If it's dropped to 75% because the market's down, we might want to hold off on rebalancing. Let's talk about it a little bit more. You typically don't sell equities to refill bucket 2 when there's a downturn. That's why we have a bigger buffer in bucket 2. For those times when you need to wait a bit for a recovery, you sell equities to refill bucket 2 when equities have performed well and you're taking profits. This is where the discipline lives. When bucket 3 is up, you sell some winners and move the proceeds to bucket 2. When bucket 3 is down, you don't sell anything. And a quick caveat here, because we are a tax-focused firm. You also want to be mindful of taxes when you are refilling buckets, especially the portion that is in a taxable brokerage account. Even if bucket 3 is up over time, there is still likely to be some positions that are down. For every NVIDIA, there's a General Electric. Things like that. So make sure when you're repositioning your bucket, you're also doing so with a tax efficiency mindset. So that goes back to harvesting losses from those positions, which is a good move to stretch your money further. So in the idea here is let's say half of your portfolio was in General Electric and half of your portfolio was in I don't know, NVIDIA, like we just said earlier. Maybe your General Electric stock has $10,000 worth of losses you can claim. You're going to want to sell that. And if it's not enough money to raise cash for what you need to refill your bucket 2 or your bucket 1, depending on where we're at with everything, you're also going to want to realize $10,000 worth of gains in NVIDIA to unwind a concentrated position without any tax consequence, because the losses from the previous sale will counteract the gains in NVIDIA. So I did a podcast episode on this earlier in the year, and it goes over the direct indexing strategy to help with this. If you haven't listened to our podcast yet, it's called The Bracket, and it can be found on all major podcast platforms. We go deeper into some of the strategies discussed here on the podcast. Most episodes are 20 to 30 minutes long and perfect for your commute or your daily workout. The episode covering direct indexing is episode 6, and you can find the link to that below. Now let's move on to the last rule. Rule number 3, the one rule everyone gets wrong. In a bear market, you stop refilling bucket 2 from bucket 3. This is the rule that saves you 6 figures over a 30-year retirement. When the equity portion of your portfolio is down 15% or more from its high, you stop the normal refill cycle. Bucket 1 keeps draining as you spend, bucket 2 gets refilled from bucket 1's cash returns and bucket 2's own bond interest. Bucket 3 doesn't get touched. If bucket 1 drops from 24 months down to 12 months during the drawdown, that's fine. You have another 3 to 4 years of expenses still left in bucket 2. The bucket system is designed to let bucket 1 drain down significantly during downturns without triggering a bucket 3 sale. We would just go ahead and replenish from bucket 2 as needed. The mistake most DIYers make is refilling on autopilot. They see bucket 1 at 18 months or 6 months, and they mechanically say, oh, I have to refill bucket 2. They see bucket 2 is low, and they mechanically rebuild from bucket 3. And they've just sold equities at the bottom, locking in losses that will never recover because now we're out of equities. So the rule here is bear markets pause the refill machine. You let bucket 1 run down a little bit more than what you normally would in normal conditions, and you wait. When the market recovers, and it does historically, bucket 3 gets rebalanced back up, and you resume normal refill operations. That's the difference between a bucket strategy that works and one that produces the same terrible outcome as no bucket strategy at all. The refill discipline is the whole game. So when doesn't this work now? And I told you at the start there are 3 situations where the bucket system doesn't work, and I want to name them honestly here. So situation 1 is portfolios under about $1 million. The bucket structure requires enough total wealth to hold 5+ years of expenses outside of the market and still have meaningful money and growth. Below roughly $1 million, the math gets tight. If your portfolio is $700,000 and you spend $80,000 a year, holding $400,000 in buckets 1 and 2 means only $300,000 in bucket 3, which is not enough long-term growth. At that asset level, different strategies work better. A better strategy is to factor in all of your income. Take your Social Security, your pensions, any annuity income you have, and see what they provide. If you need to spend $100,000 a year and these strategies provide you with $50,000 of income or more a year, using a guardrails withdrawal strategy gives you flexibility and the results you are typically looking for. So that might be something like you'll start with the 4% rule as a general guide. So you know your $1 million at a 4% rule can carve off about $40,000 of income a year. So if you have a need for $50,000, you know you can stretch it. So when markets are up, maybe you take 60 rebalance and then take that extra $10,000 and put it in a safer bucket for the next year. Or if markets are down, you pare back spending until you allow the portfolio to recover. It's just a slightly different variation of the bucket strategy because you don't have quite as many levers to pull. Now, situation 2 is for the portfolios which have the wrong tax structure. If 95% of your money is in a traditional IRA and you have almost nothing in taxable brokerage or Roth accounts, buckets can get complicated. Every dollar you move from bucket 3 to bucket 2 inside an IRA is fine tax-wise, but every dollar that leaves the IRA to fund bucket 1 is fully taxable at ordinary income rates. Now, this doesn't kill this strategy. It just means the tax planning around bucket moves matters a whole lot more. This is a case where you need the coordination between the withdrawal sequence and the bucket refill, or the strategy leaks tax dollars. You end up having to follow the strategy within the IRAs themselves. So there will be some cash and some fixed income in there for buckets 1 and 2, and that's all mixed into bucket 3's growth funds. Sometimes having separate IRA accounts helps navigate the complexity of having it all in one account. Also, if you're doing Roth conversions from the pre-tax accounts, the Roth account should almost always have bucket 3 money in it exclusively. The only reason you wouldn't want to have bucket 3 money being growth money or all in equities exclusively is if you're spending from it. So that's a world where you're already done with your conversions and maybe your $2 to $3 million is all in Roth now at this point. You're going to want to pare back the aggressiveness of that portfolio. So that way, if we see a 20, 30, 40% pullback in the market, your whole nest egg isn't down with it. It's going to be more representative of what your overall risk tolerance is at that point. Next is situation 3, and the retiree who can't emotionally leave bucket 3 alone. This is rare but real. Some people cannot stop themselves from checking bucket 3's balance every day, and the anxiety of watching it fluctuate defeats the whole point of the structure. For those clients, buckets aren't enough. We have to combine them with other emotional management structures, sometimes including a guaranteed income product that removes some of the volatility from the equation. This is one of the specific cases where a properly structured annuity, whether it's a SPIA, a deferred income annuity, even potentially a variable annuity or fixed income annuity, as long as the fees are low, can play a legitimate role. Notice that none of these situations is someone with $2 to $5 million diversified portfolio mix in a normal emotional relationship with market volatility. That specific person, which is probably you watching this video, is exactly who the bucket system was built for. And at that asset level, what is executed with discipline is one of the highest return investments in behavioral protection you can make. And I'm not going to lie, this isn't some sort of like big investment plan or strategy. This is behavioral protection. This is the psychological component of managing money. So this helps you to manage and mitigate mistakes that are from poor behaviors on your part. That's all the bucketing strategy is. So here's the takeaway. You can't time the market. Nobody can. But you can time your cash flow. And when you do, when your life is funded for 24 months by cash that doesn't drop when stocks drop, when your buffer is funded for another 3 to 5 years by short bonds that barely notice, when your growth bucket is left alone to do what growth buckets have to do, which is grow, market volatility stops being a threat to your life and just becomes background noise. My client from October 2022 is 69 now. His portfolio has gone up to about $3.1 million. He still spends $135,000 a year. He hasn't checked his balance in 3 months because he doesn't need to. His life is funded. The market is doing whatever the market does. Luckily, it's been up since then, but even if it was down, he has that peace of mind. It doesn't matter. That's what retirement is supposed to feel like. If it doesn't feel like that for you right now, if every market wobble makes your stomach drop, that's not a personality problem. That's a structural problem, and it's absolutely solvable. If you want our team to look at your specific accounts, your specific spending, and design a bucket structure calibrated to your situation, the booking link is in the description. 30 minutes, no cost, a written analysis whether you become a client or not. Because you save for 40 years to reach retirement. That deserves a structure that lets you actually enjoy it. Not a portfolio that makes you check your phone every time the S&P 500 moves 1%. I'll see you in the next video.